briefing for the first quarter of the fiscal year 25-26 GDP numbers. As you all might have seen already, the headline numbers. Next slide. The headline numbers are.
The Prime Minister's address at that forum earlier in the day in Japan, and of course he is reiterating the mantra that currently India has India but make for the world. Moving on and shifting
please silence. Please silence your mic.
Data.
Please silence mic.
As estimates, well, it's going to be a mixed bag. My colleague Srishti is here penciling in all the expectations that the street is currently factoring in.
Sir, from 18.
No, it's not. It's moving in the laptop, sir, but not. Why it's coming like this? Stop sharing. We'll just put it in PDF mode. इसको PDF मत करना. इसको PDF मत करना. Just we're trying to make it into PDF and then see.
Yes, we're just having some small technical issues in getting the PPT slides to move from first page onwards. So just give us a few seconds to get this sorted out. Sorry about it.
Why is this page? इसको बंद करो. Close all windows. Entire screen.
Share screen, click on the middle screen. Middle screen.
थोड़ा सा बड़ा कर वो दिखेगा.
Yes. Correct. That's what I said. Now you go to full screen.
Full screen is not working.
So remove the view summary. Remove the view summary.
Hide this. Let's go side to it.
Okay, so good evening everyone. I think we are ready. The technical issues have been sorted out. So I'm very happy to share with you the good news that the Indian economy in the first quarter defined expectations of a modest growth of around 6.5 to 7%, which was broadly the consensus range. In terms of constant price-based growth, it actually crossed 7.5% to register a number of 7.8% year-on-year in the first quarter of FY26. In comparison to several other countries which have already reported the data for the April to June quarter, India's numbers are far higher than every other country's first quarter, April to June quarter GDP number, which is what you see on the right side. Next slide. Thank you. The growth was fairly broad-based. Of course, April to June quarter isn't particularly known for agricultural GDP growth, hence you see that number at 3.7%. But in terms of manufacturing growth, which we will talk about a bit later, around 7.7%, and the services sector, which we have been seeing in the fairly robust PMI services index readings in the last several months, the growth rates, annual growth rates in services and manufacturing have registered a very good number. In terms of the overall mix of the GDP growth between consumption, investment, and exports minus imports, consumption 60.3%, gross fixed capital formation is around 30.4%, Exports were nearly 21 and imports were 22.8%. So we have a fairly well-distributed growth composition in terms of the different shares of GDP by expenditure, which is in line with the long-term averages. One more thing that some of you might be pointing out, which is not here in this slide, is the fact that the net indirect taxes have contributed close to 3.2 lakh crores in the GDA to match with the GDP by expenditure figures. If you look at it, basically between the first quarter of last year, which was 3.55 lakh crores, and the first quarter of this year, 3.96 lakh crores is total indirect taxes, which is 11.5% increase. Subsidies, which were 90,000 crores in the first quarter of last year, is down to 83,554 crores in the first quarter of this financial year, which is a reduction of 7.3%. So if you put the two together, you have nearly 18% increase in the net indirect taxes in the first quarter of this financial year compared to last year, which is what explains that large number. I'm sure this will sort of wash over in the coming quarters, so that this slightly larger contribution from net indirect taxes will not necessarily sustain in the coming quarters. Next slide. Yeah, if you look at the next quarter, how the current quarter, which is ongoing with September month to go, you can see that the agricultural activity in the wake of a fairly robust monsoon is going to be very high, and the tariff crop sowing is much higher than the average and the historical ranges as well. Rural consumption has held up very well. In fact, we would even argue later that urban consumption too hasn't been as weak, because we may be looking at the wrong indicators. But nonetheless, rural consumption has held up because real wages in agriculture for both men and women have risen very sharply based on data from Labour Bureau and the Ministry of Statistics on CPI rural, inflated by CPI rural. So that also helps. So a very strong agricultural sowing season, good monsoon, good storage level in reservoirs, and rising agricultural wages also augur well for the next quarter, the July to September quarter GDP numbers, and the GDA contribution from agriculture therefore can be expected to be higher. Next slide. We are trying to show you here, in the light of all the questions that we may have about the economy as a result of the tariff-related uncertainties, we want to show you how the various activity levels are stacking up now compared to the pre-COVID average on the right side, and also for the FY 24-25 period. So these are year-on-year growth numbers. E-way generation 25.8% growth in July and 20.5% in the first quarter. On the right side, you can see the comparison pre-COVID and last financial year. Same thing for non-food bank credit growth, which is 13.2%. While it is lower than the 14.8% of last year, we should also appreciate the fact that commercial paper issuance by companies and the private placement of bonds and good fundraising activity through IPOs makes up the overall resource mobilization, apart from the fact that companies are sitting on fairly large accumulated earnings from the last 15 years of growth in corporate profits, means that resources are ample for capital formation. Electricity consumption has been on the lower side compared to last year and the pre-COVID averages. Petrol and diesel consumption, and as we are explaining here, petrol and diesel consumption expanded at a slightly higher pace in the first quarter compared to the July month, or compared to the previous fourth quarter of the last financial year. Growth in electricity consumption has slowed, but it's also suffering from the high base effect from last year's heat wave condition, which prompted a huge use of air conditioners. And if you move on to the next slide. If you look at the indicators of industrial activity, the 8 core industries production, which is on the top line, year-on-year growth, only the PMI numbers are absolute numbers, not growth rates. And we also include net real sales of listed manufacturing companies, because there will be questions about the fact that GDP manufacturing has done very well, whereas industrial production growth has been somewhat on the tepid side, but because GDA manufacturing is calculated using the gross value addition of listed manufacturing entities, which has done quite well. And service sector activity are very much above par with respect to both pre-COVID and the last financial year. Port traffic annual growth rates are in line with long-term averages. In fact, the first quarter number was very good at 5.6% in general. And if you look at the domestic cargo growth, again in line with the pre-COVID averages, railway free traffic, and so on. So hotel occupancy growth also has been doing quite well in the last 2 quarters. So overall, I think the economic activity indicator that we have seen so far do not indicate any material slowdown of the momentum which we saw last year, and it is still continuing, which is what is reflected in the first quarter GDP numbers. Next slide. In terms of robust growth in trade and construction activity, non-oil, non-gems and jewelry exports were pretty strong at 12.7%, much higher than the previous periods, both pre-COVID and 24-25. Import numbers have also been robust. Net inflow of, in terms of services sector, which is a services sector trade surplus numbers, growth rate is 6.6%, but the first quarter, now in July, but the first quarter growth rate was 20.7%, maintaining the pace set in the previous financial year, last quarter of 24.9%. In terms of steel consumption, 13.8% in July, following the first quarter 8.2%, and cement production much pretty vigorous in July and in the first quarter compared to the last quarter of last year, and infra and construction goods growing also nearly at 12%. Again, this is a fairly robust set of growth indicators in different measures of construction activity. Next slide. In terms of urban demand, if you look at the UPI transactions, volume growth is about 34.9%, maintaining the very high growth rates we have seen in general. FMCG volume sales in urban India, 6% growth. Last year was 5.3. Passenger vehicle sales has been on the slower side. Some of it could be attributed to the waiting that some people have entered into for anticipating the GST numbers. And also domestic air passenger traffic growth in the first quarter was 5.3% compared to 5.6%. Which is in the first quarter of the last financial year. Next slide. Rural demand indicators, as we have shown earlier, in terms of rural wage growth, FMCG volume sales 8.4% in the first quarter, which is very much higher than 6.2% of last year. Two-wheeler vehicle sales in rural India has been much more vigorous than in urban India at 8.7%. And in July, and three-wheeler vehicle sales, obviously, it is pretty high at 17.5%, and the tractor sales at 8% compared to 8.7%, continuing from the momentum that we have seen from the first quarter of the calendar year, January to March, 20.7% and 8.7% in the first quarter of the current financial year. Next slide. Here this may be too much of data, but you can actually download it yourself if you wish to from the UPI website, from the NPCI website, where they have started giving us data on very high levels of merchant category classifications. If you look at the growth rates in groceries, fast food, eating places and restaurants, telecommunication services, etc., the annualized growth rate, because we have compared the data from June 2024 to July 2025, you look at very high growth rates, excepting in a few areas which we have highlighted. Everything else we have seen witnessed very high growth rates, more than 20% in general, in several categories. So this kind of tells us that we need to be looking at digital sales and digital transactions of services to get a better sense of what is happening to private consumption, rather than looking at conventional survey-based indicators. So it is good that NPCI has started releasing this data, and we will be sharing this with you. So this kind of should allay concerns regarding urban consumption growth as well. Next slide. Now, if you look at the capital formation, moving away from consumption and trade and other output-related indicators, overall, the central government's capital expenditure showed a very high growth rate in the first quarter. And naturally, last year's first quarter had a very low base due to the election-related slowdown in capex spending on the part of the union government. IIP capital goods 5% compared to 6.1% last year, and the first quarter was 9.8%. Capital goods imports quarterly data 2.8%, following up on the 2.2% growth in the final quarter of last fiscal year. And RBI's capacity utilization measures are pretty high, and the CMI data on new private sector investment intentions was very robust in the first quarter of the current financial year. So overall, investment activity is keeping up quite well, which you saw in the gross fixed capital formation share of GDP at 30.4% in the first quarter data. Next slide. In terms of inflation numbers, which also contributed to the fact that nominal GDP of 8.8% translated into real GDP growth of 7.8%. Inflation both at the retail level and in the wholesale level have been on the lower side in general in the course of the current calendar year, which is what you see in the data on your screens. And EPFO, net additions, year-on-year growth rate in the first quarter was 65%, very impressive growth rate. And in terms of the now jobs peak index, it is 6.8% growth in July, which is a very good growth rate compared to last year's negative or contraction of 3.7%. So overall, again, inflationary pressures are low, and the fact that there is a direct tax cut, significant cut announced in the budget, and the possibilities of a lower GST coming up in the coming month, along with the fact that the overall inflation rate is already low, means that disposable income in the hands of Indian consumers and households is going to be significantly higher this year compared to last year. Next slide. Now, obviously, this slide will be, you can play the videos, is it possible to play the video?
However, we as manufacturers and wholesalers have made alternate routes by increasing our marketing all throughout all the states in India, in UAE. We are doing it in UAE and Saudi, Qatar, and other markets also which we are looking at. The FTP which is happening between UK and Australia is affecting in a positive way the general industry, and we are hopeful that in the coming 3 to 6 months we will be able to nullify the effect of the US. But however, we are hopeful that good sense should prevail in India, especially in the US market, in the US, wherein Trump takes a decision again to roll back the tariffs from 50% to maybe 5% or 7%, which is absorbable by the Indian markets.
Do you think GST related can lead to install a new group for market?
Yes, we have already, when the 25% of tariffs have come a few months back, and now 25% more is coming today, so on the 27th. We are looking on the lines that that our marketing team goes to the other markets also. When I say UAE is a good market for us, we say that UK now has become a good market for the Indian manufacturers. The Australia has become a good market for us. I feel the marketing, but the biggest market for us is automatically India itself, because there's so many people here, population and more than 6 lakh jewelers in Indian markets. When India is already importing 800 tons of gold, largest exporters of diamond, we are looking more so to do with Indian markets also. Now, HNIs that strong people who are buying jewelry in India has increased substantially, and I feel we as manufacturers are looking also for not only outside India but inside India also to nullify the effect of the US exports. See, I think the effect should not increase from more than 3 to 6 months. I think we will be able to find different markets for the same, and we would be happy to get more people, going into each and every area and finding routes for exports. And I would request the manufacturers of the country that kindly do not offload your staff, offload your team, just be upbeat, manufacture good stuff. There are different markets for different designs, explore those designs and go ahead.
Okay, so we played this small clip from this interview by the chairperson of the All India Jewelry and Jewelry Domestic Council for the possibility with which they are looking at the current crisis as the tariff-related uncertainty as an opportunity to A, explore domestic markets, and B, also other markets which are now open to us on account of the various free trade agreements. Obviously, there is some uncertainty with respect to the duration of the period for which the additional tariff related to Russian crude oil purchase would last. But in general, the conversations are going on, and there is an expectation that we will see some kind of a resolution in the not so distant future, and therefore we do believe that our growth target for the current financial year, especially in the light of the strong showing by the economy in the first quarter, we will still retain the 6.3 to 6.8% range that we had outlined for the full financial year. At this point, of course, the downside is there in case the tariff impasse remains for a longer period, but we are hopeful that that will be resolved sooner rather than later. But this is also, as you all have been hearing in the last couple of weeks or so, we have also been using this situation as an opportunity to move forward, as the Honorable Prime Minister indicated in his Independence Day speech, to look at domestic reforms, deregulation, apart from the reduction in the indirect taxes and rationalization of the rates, simplification of procedures, etc. And also, this is an opportunity for exporters to boost competitiveness of their products and look at explore other markets as well. So collectively, between the public and the private sector initiatives, we can turn this situation into one of long-term strength and opportunity. Next slide. So just to summarize, overall, what we are trying to show, apart from the first quarter numbers for the fiscal year, which is obviously backward looking, we also try to share with you the July numbers to give a sense of whether the economy is maintaining its momentum. Of course, these numbers are predate the tariff uncertainty that came up in the month of August. The second bullet point is that domestic demand, we believe, will strengthen on account of the higher purchasing power and also the onset of the festive season shopping from next week. And in terms of agriculture output, higher tonnage sowing supported by above normal rainfall, comfortable buffer stock, and better output prospects will be there, and will also keep the food inflation benign, and non-food inflation also on account of the lower GST rates will also be giving further support to the overall low inflation scenario that we are seeing in the economy. And a couple of weeks ago, we also saw that the credit rating agency Standard & Poor's upgraded India to BBB, which is a well-deserved recognition of the macro and the fiscal performance, and we are quite confident that we will be able to maintain both, not only in the coming year but beyond, in terms of macro performance, in terms of growth, and financial and fiscal stability as well. The near-term risks to economic activity, as I mentioned already, are definitely there in terms of exports and in terms of the second-order effects in terms of capital formation because of the uncertain outlook for external demand in India's largest export market. But we are hopeful that at this point, on account of the ongoing conversations, etc., that the situation will be short-lived rather than a longer duration uncertainty. Recent policy steps, this is the formation of the high-level committees on next generation reforms, forthcoming GST changes, and the ongoing deregulation activities at the state level. You must have been seeing various announcements by different state governments on removing restrictions on women working night shifts, overtime. The Uttar Pradesh government announcing very serious reforms on decriminalization in the coming months. The lower interest rates and liquidity measures taken by the central bank will reduce borrowing costs, will attract capital formation in the economy while boosting consumption and investment. To repeat, no revision is currently proposed to the growth forecast, and while we have noticed that the 10-year bond yield in the country has gone up a bit in the last month or so, from 6.2 to 6.6% at this moment, notwithstanding the credit rating upgrade, we are confident that once the market gets a sense of our continued commitment to fiscal prudence and fiscal stability while keeping up growth, then we do believe that the long-term bond yield will return to lower levels that we saw before the recent spike. With that, I conclude my presentation. I'm open to your questions. Thank you very much.
So thank you so much, sir. We start with the question and answer session. The first question is from Shrimi Chaudhary, NDTV. Shrimi, please ask your question.
Hi, thank you, Mr. Nageswaran. So I have two quick questions. One is that the upside risk, upside rise in the first quarter, especially when high frequency indicators were mixed. Do you see that strength sustaining in Q2 and beyond? And my second question is that with the festive season nearing, do you see a risk of delayed discretionary demand until the anticipated GST cuts kicks in? Thank you.
Yeah, so the short answer to the first part of your question is yes. We do see the momentum continuing. There will be some impact on domestic spending because of uncertainties in the export sectors which are affected because of the exposure to the United States, and therefore if those units also take some decisions with respect to their labor force, etc., there will be some spillover effect on demand, but we do expect them to be somewhat of very modest nature. So overall, aggregate demand growth in the economy should hold that, because specifically in the face of these external demand risks that we are facing, the government's decision to lower the indirect taxes, which also addresses the second part of your question. We are all aware that the GST Council is meeting next week, and therefore the issue of consumption being held back, waiting for the new GST rates to be announced, that will be over by the end of next week, and we still have a good window of 4 to 6 weeks before the festive season holidays kick in, both for the Puja holidays and the Diwali holidays. So I think the month of September, after the new GST rates are announced, we'll see a pickup in the consumption that has been held back or waiting for the new rates. So in that sense, that will also not necessarily remain a drag into September.
Now I call Ashutosh Kumar, Fortune India. Would you like to speak out your question, or do you want me to read it?
Yeah, ma'am. Thanks, ma'am. Yeah, ma'am. Am I audible?
Yes, we can hear you.
Yeah. Good evening, sir. I'm Ashutosh from Fortune Magazine. What I'd like to understand from you, sir, is what would be the likely impact of the 50% tariffs imposed by the US on the GDP in the coming quarters? We know that the economy has been in momentum in the last quarter, from the last quarter of the previous financial year, which continued in the first quarter, as is evident from the numbers. So, while some tariff loss to the GDP may be offset by the economic gains from GST cuts, what would be the net impact in GDP numbers, so to say?
Obviously, it is a very difficult exercise, regardless of the sophistication of the models that one has, to be able to give you a precise GDP growth rate impact of the tariff measures because of the potential for second or third round effects, not only in terms of exports to the United States. It will also may have implications for exports to other markets, and also because of the implications coming for capital formation due to the uncertainty, etc. But as I said, we expect that to be short-lived, especially the penal tariff for the purchase of Russian crude. But the industry, on the other hand, has more or less planned its strategy. As you heard from the chairperson of the Gems and Jewelry Domestic Council, with respect to the original 25% tariff, the industry has already made plans to sort of absorb a portion of those tariffs and also distribute some of the costs to other elements inside in the export chain, and also diversify into other markets to be able to absorb it and still continue to maintain the export performance. So I think the sooner we see the removal of the penal tariff, then we can say that the impact of the penal tariff will be concentrated only in the second quarter, fiscal second quarter, and not necessarily continue. If anything, in fact, the removal of that uncertainty may actually unleash even higher growth in the fiscal third and fourth quarters, compensating for any possible impact in the second quarter. So while it is difficult for me to give you precise estimates because of the various sort of loop effects of the tariff at the moment, the downside risk, as I pointed out, is there. And there are various private sector estimates which range from something as low as 0.2% to something as high as 1% if it continues for a full 12-month period, etc. But those are extremely uncertain estimates. They don't necessarily have to come to pass because there is conversation that is going on between the governments involved, and therefore at this stage, while we should acknowledge the downside risk, I think it is not necessary to expect it to be of very significant nature.
Next is Siddharth Upasani from Indian Express.
Thank you, ma'am. Hi, sir. Siddharth from the Indian Express here. A couple of quick questions. One, could you help me understand how so the financial, professional, and real estate services that's grown 9.5% or so, which is the highest in 8 or 9 quarters. But the first quarter has seen fairly weakening of credit growth. So how exactly has that segment? Second, I mean, this is the second quarter in a row that the growth number has been much higher than expected. Do you have any idea why it's become so difficult to predict GDP growth? I mean, even the RBI was 6.5% for this quarter. Last quarter it was similar. Thank you.
So I thought I kind of alluded to both your questions in my remarks. Bank credit growth is not the only indicator of financial sector activity. There is insurance, there is real estate. In fact, if you look at the cement and steel, cement production and steel, etc., we did show that construction activity was robust, number one. Number two, I also said that fundraising through commercial issuance of commercial paper and equity market funds mobilization were quite robust, etc. So I thought I answered that question already, anticipating this. And the second point you made about how is it that we are missing the GDP numbers, I think I alluded to that by pointing out in the last slide the various categories of merchant category classifications and digital payments, the kind of growth rates we are seeing in services consumption, in terms of the household services consumption, which is not very well tracked so far. And these numbers show that the growth is robust. And in fact, I have two of my colleagues from the Ministry of Statistics also on the call. In case they have any further light to add, to shed on this particular question, they may want to come in. If you wish to, please, my colleagues from MOSPI, on the last question of the gentleman.
Hello, good afternoon. I am Siddhartha Kundu, Additional DG of National Accounts Division, MOSPI. I would request Mr. From Indian Express, could you please repeat the last question?
Sure, sir.
The GDP number is much higher than what even the RBI had anticipated, and that the miss was quite large even in the last quarter. That's what he said. So basically, what is it that is making most of us miss the growth numbers? Why is it that the surprise has been so significantly positive?
Essentially, we calculate this quarterly growth rate on the basis of benchmark and indicator. Okay, for these financial, real estate, professional services, and public administration, essentially the service sector, that had performed excellently. And as per our data, that services sector is performing about say 9.3% overall, and financial sector, that credit growth, deposit, about they have growth over around 10%. IT sector also performed excellently, 7% share, and it has also shown the very good growth rate. So further, the public administration, defense, and other services also showed a fantastic growth rate. So on the whole, except that mining, all the sectors more or less were growing excellently. So overall growth was reasonably good. In fact, we are not doing any prediction in MOSPI. We are calculating on the basis of the exact figures, whatever is made available to us from different sources. So this is the observation, and we hope that we will maintain this growth rate in future also.
Thank you. In fact, just to clarify, on the, for example, the manufacturing GDP which I mentioned, some of the people, we ourselves had this discussion internally, given the growth rate in industrial production growth rate in industrial production, IIP was lower in the first quarter compared to the first quarter of last year, and yet the manufacturing GDP growth has been even slightly higher, both in real terms and in nominal terms. One answer is that IIP is based on the framing of the various sectors set in the base year 2011-1. Whereas the GDP of manufacturing is calculated using the gross value added of listed companies, which constitute almost 80% of the overall GDP of manufacturing. That is why we included the figure on the real final sales of manufacturing companies, which has done very well. And we also know that the input prices came down, whereas the output prices of the manufacturing companies went up, which is the reason why GDP of manufacturing was 10.1% in nominal terms, and it doesn't necessarily, therefore, it is not reflected in the growth rate of the index of industrial production, which is a frame set in 2011-12. In fact, I would even say, even the GDP of manufacturing based on listed companies will ignore the massive production of mobile phones that is taking place in unlisted entities like Apple India, which is not listed in India. So in that sense, we might even say even the stellar growth numbers, once we have the kind of base layer and the weights and the constituent division, all of which are supposed to be completed by the middle of next calendar year 2026, we will have a much better representation of the Indian economy and the transformation that has happened over the last 11 years.
So just a follow-up, if I could, you just mentioned the the updated GDP series. Does that mean the GDP numbers should be larger with the new series?
So I don't want to speculate on which way the revisions will go. That is way too early. I mean, it probably isn't necessary to do so at this stage.
So we move on to the next question. Priyansh Verma from Money Control. Priyansh, are you there? So, okay, then we'll take the question from Nikunj from Reuters.
Good evening, sir. I wanted to ask you if the strong growth in manufacturing that we're seeing, do you see US tariff playing a role here because of front loading of orders? And do you see the growth being affected in the next quarter because the additional tariffs came into effect from August? So will that have an impact on manufacturing if US tariffs are a reason for this higher growth?
Yeah, so thank you, Nikunj. I think the export numbers did not necessarily show that there was any front loading in the first quarter because of the anticipation of tariff. Because I think the idea of even the 25% reciprocal tariff itself came up towards the end of July. So I don't think there is some sort of a base effect, a negative base effect operating from the previous quarter on that account, because nobody anticipated, even the very few anticipated that even the first 25% reciprocal tariff, which came up towards the end of July. So I don't think that is a big, that you're not looking at a split tariff from the first quarter numbers in that sense. Now, will there be an impact on manufacturing in the second quarter? Yes, to the extent that there is, gems and jewelry, there is textile garment manufacturing, and some of them also, some auto components or engineering goods exports being there. Yes, there will be an incremental impact, but again, if there is, and at this stage, it is natural for people to voice concerns about a larger impact, while at the same time, they will be taking steps to diversify their markets and also seeing whether some of the buyers will continue to stay buyers by sort of sharing the additional burden between the buyer and the exporter, etc. So it is always possible that the final impact is lower than what we fear, because right now there is more uncertainty and less number of answers to the questions we face. But as the days and the weeks progress, the natural resilience and the adjustment processes of businesses, and also on the part of buyers because they are used to a specific supplier, etc. All these factors may have different kind of implications and impacts for the final consequence or impact on the manufacturing numbers. So right now, yes, it is a safe way to say that there will be some kind of a negative shock on the manufacturing numbers in the second quarter. But how big that is from, as you know very well, it's very difficult to be precise about it at this stage.
Prakash Priyadarshi from ET Now, please go ahead and ask your question. Prakash Priyadarshi? Prakash, we can't hear you, so we'll move back to Priyansh. Priyansh had, because his mic is not working, so he has sent his question in writing. Sir, I'm going to ask that on his behalf. So the first question is, the gross tax revenue has grown only 0.8% in April to July as against projected growth of 10.8% in the budget. With the expected revenue shortfall with GST cuts, is there any risk to fiscal deficit? That is number one. Number two, what's the outlook for private investments going forward?
So as far as the overall fiscal outcome is concerned, non-tax revenues have done very well, indirect taxes have done very well, and as I said, we are committed to fiscal prudence and fiscal stability. Despite the difficulties and challenges during the COVID time, we have stayed true to the path of fiscal prudence. And as promised, in the year 2021, we have brought down the fiscal deficit ratio by more than half, 9.2 to 4.4, and we have seen the benefits of that in terms of the reduction in the cost of capital for the government, which therefore naturally gets passed on to every borrower in the country in terms of the overall interest rate levels coming down, and therefore that is an important fiscal stimulus for economic stimulus rather for the entire country. We are quite aware of that, and therefore the government will be quite determined to ensure that there are no fiscal slippages in the coming year. The question of investment, yes, as I said, we don't have granular data yet for 24-25, but if you look at the bottom-up figures on the basis of what we have seen with respect to listed entities, the financial year 24-25 actually saw a pretty significant pickup in capital formation on the part of the private sector. And we also showed in the slides that the investment intentions of the private sector in the first quarter went up by more than 200%. In one of the slides which we showed as well. So I think prior to the onset of the tariff uncertainties and en passe, there was momentum, and I think the domestic demand situation is becoming clearer. While there will be some impact due to uncertainty facing export-oriented units, particularly to the United States, and therefore the demand coming from workers and employees in those enterprises, etc., at the aggregate level, that will not be such a significant one, which will and the effect of the direct tax reductions announced in the budget and the indirect tax reduction coming up soon, they will be more dominant in ensuring that domestic demand remains quite strong, and that will be an important offset to the external trade-related uncertainty, and therefore I believe that the private sector will have enough demand visibility to continue with its capital formation plans. And recently, I think one of the capital goods equipment manufacturers in the country did voice optimism about their order book as well.
Now we have Sapna from CNBC.
Hi ma'am, thank you. Good evening, sir. So two questions. One, of course, you are indicating very clearly that the downside risks or the uncertainties being faced currently are expected to be more short-lived rather than long-lived, and hence, impact on various indicators. So what gives the confidence that discussions or negotiations with the US on the tariff issue are actually going to go forward? How are they going to shape up? Any expectation there? That's one. Second, sir, in case things don't work out the way they are expected to work out during the financial year, what kind of impact can we actually see on various fronts, be it exports or investment activity, or basic growth numbers, consumption, etc. I mean, in your view, that's one. And second, sir, are we totally confident that the council?
Sapna, I think this is the third one.
No, sir. The second one. The first one is so sorry. It's rolled into one.
First question was about the level of what makes you confident that it will be short-lived. That's what you asked. And the second question is about the quantitative impacts in case it is not. Now you're going to the third one. Before I forget the first, let me answer that. Sure. See, what gives me the confidence? I think in general, I think both countries, as you have been also seeing from some of the statements coming out of the United States in the last couple of days or so, and the fact that India has also been responding extremely carefully with respect to the developments happening in this matter. I think the conversations are going on, and it is difficult to be, precise and concrete with respect to our intuition or hope in this matter. But it is a hope and intuition that the additional tariff that India is facing will be short-lived. Now, with respect to the impacts, if it is not, as I said earlier, quantitative answers are very difficult to come by because no matter how sophisticated your model is, it is very difficult to factor in second and third round effects. It's very easy to calculate the growth, the value of India's exports to the US and the tariff, look at some demand elasticities, and then come up with some number, and then add a little bit more to the spillover effects on other aspects of expenditure, GDP by expenditure, and then you can come up with the back of the envelope kind of number. That will be no different from any sophisticated model-based estimates as well, because by nature these are all very difficult to estimate. So I don't want to waste all of our time in trying to guess those numbers. We will see as the days go by, and I sincerely hope that it won't be necessary to spend too much time on trying to compute those growth impacts, because of my optimism that things will resolve themselves reasonably quickly. Now, what's your third and final question? I think Dr. Bashir is being very liberal to you, really letting you ask 3 questions.
Thank you very, very much, both of you. Sir, the last one, of course, is the fact that how confident are we that actually the GST Council will go ahead with the kind of rate reductions that the economy and everyone else is expecting, and any kind of an impact that, rather in terms of contribution to GDP, any kind of indication you can give on that front to counterbalance?
The same answer to the question number 2 applies here. I think it's difficult to give you quantitative estimates of the impacts of GST reduction on specific goods and services on the consumption, and therefore the spillover effects on investments and on the overall GDP growth. We'll have to wait and see. I don't have precise answers to the questions.
Thank you very much.
So next is Deepak Mondial from New Indian Express. I'll read out his question. How much of growth is due to government spending, whether in form of infra spending or government consumption, which has grown by 7.4% in Q1?
So I think those numbers are already indicated in the press release of the Ministry of Statistics, because capital formation includes government capital formation, but right now we don't have disaggregated data on capital formation. Whereas what is captured in the GDP by expenditure is the government's consumption expenditure growth, which is indicated. What's that number?
7.4.
7.4% year-on-year in real terms. Yeah. So the government consumption expenditure has grown 7.4% in real terms, compared to 0.3% contraction in the first quarter of the last financial year. And in nominal terms, of course, you have pretty much the same numbers of around 10%. But the capital expenditure is part of the gross fixed capital formation, and you don't have the disaggregated data yet.
Next question is from Karishma. Karishma, please go ahead and ask your question. I think she's having network issues, so I'll read out her question. With India's economic relationship with China likely to improve over time, do you see specific sectors that could benefit from greater trade engagement or find some respite from current pressures?
Yeah, it will be difficult for me to give an answer to the question about which sectors would benefit, etc. I mean, one obvious answer is if there are, as is being discussed in the media, if there are resumption of flights, etc., I'm sure the aviation sector will benefit. That is an easy answer to you, but beyond that, I can't give you specific answers.
So I think this is the last question from Pragya Times Now. Her question is the impact of tariff on growth and how far FTAs will ease the impact and which sectors might get hit?
Yeah, again, I think we have answered this question earlier as well. So the negative impact from the tariff in terms of shortfall in demand that may arise in the United States, and the extent to which they may be offset by the market access that we may now have in other countries with whom we have concluded free trade agreements, etc. I think to be precise about them is next to impossible at this stage. We will only be able to, measure them after the fact, and any ex-ante estimates will be as imprecise as you can imagine at this stage.
So with this, we come to the end of the media briefing.
Ma'am, this is Rajesh Singh from ANI. I have raised my hand since long. Can I ask
because
the
you
question?
didn't mention on the group.
Yeah.
So you please go ahead and ask your question.
Yeah. Yes, sir. Two quick questions. If you can hear me, the first one is that as you said that the 7.8% growth is mainly led by consumption and investment. Do you think that Indian domestic market can offset export losses due to this US tariff because of this consumption and investment? And secondly, any estimate have you done on the out of this 7.8%, how much has come from front load?
No, so I think will the consumption growth or will the higher than expected GDP growth offset the tariff related negative effects? Answer is yes, which is why we said we are not downgrading our growth estimate for the year. We have kept the range at 6.3 to 6.8%. That gives you enough indication that despite the reciprocal tariff and the penal tariff having been imposed, after seeing the resilience of growth in the first quarter and the data for July numbers, etc., we are maintaining our growth range for the full year. Now, as for your second question is?
It's on how much of this 7.8%, any estimate on front loading?
I don't think there's any front loading here, because I think I did answer the question as well, because the tariff issue did come up very actively into the frame of discussions towards the end of July and not before.
Is that all?
Okay.
Anybody else who would like to ask a question? Sir, I think this was the last question, and now with this we come to the end of the media briefing. Thank you so much for sparing your valuable time to satisfy the queries of all the media persons. And I would also like to thank Mr. Siddharth Kundu for having joined and for his remarks. Thank you, everybody. Thank you, sir.
Thanks to my friends and colleagues in Moscow, and also thanks to all the media friends for joining this call. Wish you a very good weekend. Thank you.
Thank you, sir. Thank you.